Today, some CBA customers face delayed interest rate pain. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, a CBA bank decision to protect its customers during the COVID-19 pandemic could in fact deliver a steep rise in monthly mortgage repayments just in time for Christmas. Back in May 2020, CBA said it would cut home loan repayments to the minimum amount for up to 730,000 customers with variable interest rates who paid by direct debit, saving around $149 a month, which the nation's largest lender said people could use to pay bills, quote, during a fraught period. CBA was the only major lender to make such a move, and it's estimated that it freed up some $3.6 billion for the broader economy. Gareth Ed, CBA's head of Australian economics, said an incredible level of monetary policy tightening was yet to hit the real economy and would ultimately force the Reserve Bank to start cutting the cash rate again next year, according to the Sydney Morning Herald. 2 years ago, after the CBA move was implemented, lags of up to several months between RBA rate hikes and increases in CBA's customers' minimum payments mean many home loan borrowers felt the impact of the central bank's May rate rise only this month, a delay which Ed said would probably have a macroeconomic impact. There is a lag between changes in the cash rate and the impact it has on monthly cash flows for borrowers on a floating rate mortgage, Ed said. At CBA, for example, by December, the impact of already announced rate rises on monthly cash flows for mortgage holders on variable loan rates will be a four-fold increase compared to July. As such, there is a strong case to slow the pace of rate rises, given we expect consumption growth to slow significantly as the lagged impact of rate hikes impact many households. Financial markets expect the official cash rate to peak at around 3.6% by March and then decline slowly by Christmas 2023. And between now and March, the RBA board has 6 meetings, and to hit 3.6%, it would have to raise the cash rate by half a percentage point at one meeting and then a quarter percentage point at all the other meetings. These would be the fastest and most aggressive interest rate hikes since before the 1990-91 recession, when the bank had interest rates at 17.5%. Ed, one of the first economists to predict a tightening monetary policy to start in 2022, expected the RBA, which has lifted rates by half a percentage point at its last 3 meetings, to slow its increases to a quarter of a percentage point, and he predicted the official cash rate to peak at just 2.6% before the RBA cut it in the second half of next year, forecasting a combined half percentage point reduction in the cash rate at that time. Now, NAB data suggested that the combination of higher interest rates and inflation is already starting to bite. Its measure of financial hardship showed a 35% rise in the proportion of Australians struggling with the cost of living in the June quarter, compared to the survey low of 29% in the March quarter. Hardship was most widely spread in Western Australia at 43%, while inflation in Perth was at a nation high of 7.4%. The biggest increase, though, in hardship was seen in New South Wales and the ACT, where it soared from 26% to 38%. Rachel Slade, NAD's personal banking group executive, said that while most of the bank's customers were in a good financial position, pockets of concern remain. 70% of NAB's customers are ahead on their loan payments, but we do know that there are some people who are feeling the pressure of an increased cost of living, Slade said. And that's really the point, of course, because of this lag effect. Rates are actually going to continue to rise, and that will flow through to hit household budgets through the rest of this year and into next year. And indeed, the latest inputs from my surveys, which are run weekly, is showing continued stress among households. I'll update that again at the end of August. So it's true, I think, that at some point the RBA will have to turn around and drop rates. But the question is, at what timing? How long will they take rates higher first? Because, of course, inflation is still heading in the wrong direction and is significantly above their 2 to 3% target. So this is going to play out not over months but over years, I think. But we'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.